Hello everyone, and welcome to Net Diligence Virtual Cyber Risk Summit. My name is Heather Osborne, and I'm the Director of Global Events and Programming here at Net Diligence, a cyber assessment and data breach services company. We are pleased to extend our thought-leading content into the virtual space with this webinar series. Visit the conferences page on our website, www.netdiligence.com, to find out more about our online and in-person programs. Before we begin today, I'd like to extend our gratitude to our virtual cyber risk sponsors and our nearly 100 industry-leading speakers, without whom this program would not be possible. For today's webinar, we will be using the ON24 platform. Right now, you should be viewing the ON24 dashboard, which shows the live viewing screen and other features. During this presentation, all participants will be in listen mode only. Today's presentation will last approximately 60 minutes. Panelists will be taking your questions throughout the presentation. Simply type in your question and hit submit. You may also use this feature for technical questions. In the bottom corner, you will see a widget called Resources, where you can download assets our presenters and sponsors have provided. Just click on the resource and it will be automatically downloaded. If you are interested in receiving CLE or CE credit for today's webcast, please navigate to the CLE CE box in the lower right-hand corner to make your selection. This will ensure that you are emailed the CLE CE questionnaire to complete your application for credit. Additionally, please note that you must remain online for the duration of the program and answer the 3 polling questions that appear during the presentation. As a reminder, this webcast is being recorded. Following the conclusion of this webcast, you will be sent an archive link for further viewing or sharing with colleagues. This webinar will also be available on demand on our website. Again, thank you for joining us here at Net Diligence today. We hope you enjoy the program.
Good morning. I'm Florence Levy with Marsh's Cyber Practice, and welcome everyone to the second edition of the Net Diligence All Virtual Conference in 2020. I'm certain that there's some disappointment in missing out of the in-person networking for this event, but also that we aren't in the coveted location of sunny Santa Monica. That being said, Net Diligence is excelling at virtual conferences these days and has a terrific lineup of meaningful cyber content. I'm excited to welcome you to the first panel of the conference, State of the Market, Impact of COVID-19. The cyber market is quite fluid, seemingly shifting from day to day, and this session will be a continuation of the market update discussion from June with the same panelists. With the onslaught of ransomware and the trailing implications of COVID-19, 2020 has not only been a challenge in our everyday personal lives, but it has also been quite challenging in the world of cyber risk and insurance. Today, we will explore how underwriting is changing, the general health of the cyber marketplace, the impact of claims, pricing, capacity, and rate changes, and macroeconomic factors impacting this marketplace. Without further ado, I'd like to introduce my esteemed panel of cyber experts joining me today. All 3 have been in cyber insurance for many years and have an acute understanding of the market trends since cyber became top of mind for risk managers and corporate boards alike. First up, we have Dan Trueman, who is the Global Head of Cyber at Axis, based in London. Next, we have Nick Economides, who is an e-risk insurance underwriter and Vice President at Crum and Forster. And last but not least, I'd like to introduce Shannon Groeber, Executive Vice President at CFC Underwriting. She looks after CFC USA, which offers admitted cyber insurance through CFC's Connect platform. Welcome everybody today, and thank you for joining us. So let's jump right into things. We are around the final corner and quarter of 2020, and I'd love to have a discussion about the general health of the cyber marketplace. Dan, perhaps you can start us off and comment on carrier profitability and some current challenges that you're facing.
Wow, yeah, what a place to start, and I think it's a very fair place to start as well, to be honest, Florence. I think we're in a marketplace. Carrier profitabilities obviously by definition exist on a spectrum or a range. Some carriers are going to be more profitable than others. But I think it's fair to say that with some of the current challenges, and we'll unpack them as we go through here, some of those being things like ransomware, the need to wait for systemic losses, some of the need to push for return on capital, and frankly, just the rising severity and frequency of losses across the board. We've seen carriers exit the market, and you started this with saying how this is changing on a daily basis. And in the last few days alone, in the last few weeks alone, we've seen carriers exit the market. And I think it's fair to say that carriers wouldn't be exiting the market if there was consistent profitability. I think, yes, some carriers are profitable, but it isn't a universal, and there is a wide range. And there are certainly some carriers that are not profitable, and the market is going to have to move to reflect that.
Thank you, Dan. Shannon or Nick, do you want to jump in? Do you agree with those comments?
Yeah, this is Nick, if I can jump in. I generally agree with those comments. I would add two observations. The first observation is I believe that there are carriers in the market that are better at handling losses and able to handle those losses at a lower cost than other carriers in the market. And I think that's giving them a real competitive advantage right now. And my second comment is that I think the market has made a mistake for a number of years by trying to price accounts to their individual risk. But what that misses, and I saw this in an interview, so it's not my original thought, and I apologize that I don't remember who said it, but the commenter said that we were making the mistake of not pricing for systemic risk in the market. And I think that's true. We've driven prices down, and let's pick on manufacturers, wholesalers, and other accounts that hold very few records. Those types of accounts really saw their prices come down for a number of years and get to a very low place. But then I think we found that ransomware was just as much a problem for those types of risk as other types of risk. And they, in my mind, became to be a very underpriced segment of the market because we didn't price for that systemic risk.
So, Nick, before we move on to Shannon, back to your first comment regarding certain carriers being able to handle the risk or the losses better. It was a little cryptic. Can you maybe expand on what you mean by that?
Sure. I wasn't trying to be cryptic, but I do believe that some carriers really understand which events, which losses, based on their specific attributes, how to get them into the hands of the right vendor to handle that process efficiently and effectively. And other carriers may not have that same expertise and may be allowing the insured to direct the loss to vendors that are not quite as prepared to handle the event as efficiently and effectively. And it just results in a higher cost of handling the event, which, over the course of many losses adds up to be a significant difference. Is that a little less cryptic?
Yes, that's helpful. Thank you. Shannon, is there anything you wanted to add to just kind of the general outlook of the current marketplace before I get into some more specific questions for the panel?
Yeah, absolutely. And so just taking some of Nick's comments and the extra detail that he just added, I mean, certainly there are a number of levers that you can use to improve your underwriting profitability versus just gross written premium. And I think if you ask any carrier, regardless of where they compete in the space and how new they are to the cyber market, everybody would consistently say that they would love to get more rates for the risks that they're assuming. But supply and demand has always threatened the carrier's ability to get what we would call the right premium for the risk, especially as we continue to expand coverage. And so I think to Nick's point, there are other levers that carriers can use to be successful on a long-term basis within the cyber market, like controlling some of the losses from the onset with the use of appropriate vendors and controlling expense.
Thanks, Shannon.
Before we move on, Florence, can I just, because I think it's really valuable to unpack some of that as well, because I totally agree. I think this is about, how do you make your cost of sales as efficient as possible? That absolutely, all of those levers matter. But I think there is a really fundamental point that we're sort of talking about, and Nick was really sort of moving to as well, this idea that actually as we better understand the total cost of the goods, it isn't just about how do we more efficiently apply claims. We need to make sure we're getting enough in the front end to deal with the whole range of losses we have available to us. And I think, and absolutely, as Shannon talked about, the supply-demand curve has meant as we push that down, those margins have become ever thinner. Unfortunately, a lot of the larger events or the potential for large events have become ever bigger. And we exist in a macro environment where we need to be able to respond to that too. And I think that, we need to keep pressing, not just pricing because the market's inefficient, but because the market was inefficient in pricing in the first place and needs to move forward and be more sophisticated about its pricing.
That's helpful. So I think what I'm hearing from the panelists is that if we're talking about where losses might be contained, it's not just limited to the primary, and we're seeing losses well up large towers. And I think you're alluding to the fact that that might be one of the reasons why, in particular, excess rates are increasing. Is that a fair assessment?
I think for me, I think the reason excess rates need to increase is two sides. One, yes, events are becoming larger. We're seeing a greater amount of severity. But two, the pricing was wrong in the first place. This sort of insipid myth we've had of ILF pricing, that you should price as a percentage of the underlying and keep a relative percentage. By the time you compound that, you don't have to get very high in a tower, and you're suddenly not getting very much money at all. And yet, as a risk pricing, if you genuinely said to yourself that, this is reflecting the fact that this will happen 5 in every 100 years, we know that these events are happening at a greater frequency than that. And so we need to be able to price properly for them at the right levels at the right time. And I think that's the challenge, is that actually the methodology we were using for excess pricing was wrong. And we need to look at risk pricing, not ILF pricing.
Right. So now that claims are rolling in, you're really seeing it as a correction of the pricing versus hardening of the market?
I think there's a bit of both. I would have said this was affirming a while ago. I think it's a hardening now because we're seeing this change on a lot of factors: terms, conditions, price, and the way we're looking at the risk.
Shannon, it sounded like you wanted to jump in there.
You know me well. I couldn't agree with those comments more. I mean, I think that we've been hearing from excess carriers for years that they had a really hard time justifying these traditional increased limit factors, which were created out of a completely different product and reflective of completely different claims trends. So now that we are as far into the cyber market as we are, and we've got much more mature claims data, I think these, concerns that excess carriers were expressing for years about that concept are really justified. But again, we're in the situation where it's so much harder for them to get the actual correction in those rates because there are new carriers that are willing to jump on those towers. The difficulty with these excess markets as well is that they have far less visibility and control into that expense management than the primary carriers do, and they're expected to just follow the lead and write their check at a much larger discount, which is just not sustainable long term.
That's a great point, Shannon. So before we kind of move on to the next topic, I think that it's important to talk a little bit about the capacity in the cyber marketplace. I think it's fair to say that it's much smaller overall from a market size perspective as compared to property, for example. But I guess my question to the panel is, do you think overall that capacity is adequate, especially as quickly as things are changing right now? And whether or not clients have been satisfied with the capacity that they're able to build. Does anybody want to tackle that one first?
Hey, Florence, this is Nick. I'll jump in real quick. I think one of the problems with capacity is that we're talking more about the large risk Fortune 500 space here, the national accounts that are looking to buy higher limits. And I think one of the challenges is twofold. First, there's limited buyers in the market, which make it a little hard to get that spread of risk and to build enough premium as an excess carrier to justify the limits that you're putting out. And the other problem that we have is what I talked about before, is pricing for that systemic risk. When we were talking about rates in the $6,000 a mil area, I think it was very difficult for carriers to collect enough premium and cover that systemic risk, that a loss was just going to happen out of just dumb luck because the premium wasn't there, and that made it really hard to attract and keep carriers in the market.
Thanks, Nick, and I think that's a natural segue to our next topic. We've talked already quite a bit about pricing and rate, but we haven't really gotten into the discussion around claims. And before we talk specifics about what you're seeing, I'd love to chat a little bit about the myth that cyber carriers don't pay claims. I certainly would say, being a broker for many, many years, this is something that I deal with less frequently than I used to, but still a myth that's out there. And I'd love to know what you might say that would be counter to this. Shannon, do you want to take that one?
Yeah, I sure do. I'm going to try and put my snark away for this one, too. I mean, this has been a frustrating part of the growth and expansion of cyber insurance, and especially seeing it from my previous roles as a broker, it was really frustrating to have to go out and sort of combat this assumption and provide, far more evidence that there were carriers that were paying claims than the few headlines that would make their way to prospective clients that were very skeptical about purchasing cyber insurance. And now being on the other side of the business, I think we don't necessarily help ourselves when we as carriers have this need to sort of publicize how few claims we're receiving and how little, we're paying in terms of losses. And, the former broker in me just feels very skeptical when I see those types of headlines, when my natural assumption is, well, there must be some really restrictive coverage in that policy, or there must be some loophole that is allowing these carriers to evade the claims that we can see, outside the lens of insurance and outside the lens of what is actually triggering our policy. We can see that these events should be increasing in terms of frequency and severity when they are actually reported to carriers. And we know that the market of insureds is increasing as well. So it is really frustrating. I think this is just going to continue to be one of the battles that we have to fight. We just have to continue to educate and promote, how valuable cyber insurance can be for an insured when it does have the right policy language, when it does have the right provisions that are going to allow for that claim to be accepted, and when it does actually reflect the true exposure of the insured versus, just the cheapest policy that's out in the market.
I think that's a brilliant point, Shannon. I think that there's such a social value in insurance, and we seem to forget that in terms of the whole process of understanding the risk transfer, understanding the client, providing a policy that actually responds to the client's needs at a price that means the market is sustainable has an enormous value. And I think, as I say, we wouldn't be seeing carriers exit the market if we weren't paying claims. I think we all know there's a significant number of claims being paid, but we must make sure that they're being paid on policy wordings that fit the insured and they're getting what they expect.
I thought Shannon was spot on as well. One of the things that frustrates me in the market is when I hear people come to me and they basically say something along the lines of, we've done an extensive analysis to determine that the lowest price is. Well, there's another side of it, and, comparing price against price is one thing, but, there's some big differences in coverage that's available in the market, and those differences can make the difference between a claim being covered and a claim being denied, to Shannon's point. And I think we all get bad press when people buy shoddy coverage, and then they get unhappy when their claim is not covered.
Yep, thank you, Nick. Thanks to all of you for those comments. We're actually going to get a little bit more into coverage issues a little bit later, but I want to stick with the claims point for just a couple more minutes. And related to this, I know that there's been talk for many years of carriers having rights to subrogation, and in fact, I recall this very issue being a coverage concern for many years, although I've never seen it, or I have not yet seen it in practice. So I'm going to punt this one to Shannon. You in the carrier space, are you looking to enforce subrogation rights as an additional means of recovery?
I think this is a really interesting angle and a new trend that's coming into the market now. I shouldn't say new trend because we've been suspecting that this is going to be a practice that that would come into play. But, for years we've sort of made this argument that cyber insurance and tech E&O are very different products, and there's not really any sort of overlap between them. And I think now is when we're going to see some real aggregation issues that are coming out of the most recent claims trends, in particular ransomware. when you have more of these tech providers that are responsible for keeping insureds protected and, through negligence or, just error or accidents, are going to see more of this activity that's going to have a cyber impact for an insured in any industry segment, but then relate back to that tech provider. I do expect that we're going to see more carriers that are looking to control their losses by going the subrogation angle.
That's super interesting, and you said the buzzword, so I think it's appropriate to move on if we want to flip to the next slide. That buzzword happens to be ransomware. So all I've been hearing about lately is ransomware, 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 and carriers seem to be acutely focused on ransomware preparation, employee training, and management of your insureds. So my question to Nick is, has this been blown out of proportion as a scare tactic, or is the ransomware threat everything it's cracked up to be?
Oh, absolutely. It's everything it's cracked up to be. It's amazing how little press this has gotten. But since we did this panel the last time, and I think some of my fellow panelists saw this before me, but since about July 1, the escalation in ransom demand amounts has been significant and downright scary. And I think it's going to have a real impact in the market. Right now, underwriters seem to be trying to underwrite their way around this by selecting risks that they think have the right controls in place. But long term, if we can't find ways to stop the bad actors in their tracks and really reduce these losses, I'm thinking that we're not going to be successful in strictly underwriting our way out of this.
So the demands are up.
Yes, I think it's a really good point. I think that we're seeing sort of ransomware. There's a number of issues, isn't it? I think we're not seeing as many of the spray and pay type of events we used to see. That doesn't mean frequency isn't up too, because we are seeing more. When you can go and get ransomware as a service, then you're certainly able to, for not many dollars, go and be able to be even a bit more targeted. But we are definitely seeing the big game hunting sort of move to it, and I think that's one of the sort of analogies we also try to play on is this big game hunting. There is a predator versus prey moment. So I think there is a logic to trying to select clients that are doing something in order to manage their behavior as prey and sort of be better able to cope with what the predator's doing. But at the same time, we are absolutely going to have to do more as a market on other terms. Is this about attachment points? Is this about deductibles? Is it about enforcing certain standards? Or frankly, is it about actually looking at whether some of these ransoms are payable in any way, shape, or form? We're going to get there eventually.
So I'm hearing both frequency and severity and more scrutiny around underwriting. My next question really is, do you view the ransomware threat in particular a specific area that you're trying to price differently, or how are you pricing it? I guess a better way to say that is, it's one thing to talk about the demand, but then it's another thing to talk about the consequences, whether the demand is paid or not, and whether the network is brought down or not, right? So we're talking about ensuing business interruption losses as well. Can someone sort of comment on that overall?
Hey, Florence, let me start with this, because I don't want to pick on you, but I think you accidentally said something that was a misnomer of sorts. It's not just about the systems being brought down or data being unavailable, but it's also about data exfiltration. The bad actors more and more often are going in with a number of tools, and the last tool you see is the encryption of the data on the network, but they're also stealing data and holding that data hostage and using that. So even when we're able to get the systems back up and operating relatively quickly, we still are facing significant ransom demands to prevent them from releasing the data that's been stolen. I think that's
a great point. From a data perspective, it's the confidentiality, integrity, and the availability of it, right? That's something that we all talk about. So Shannon, Go ahead.
Yeah, sorry. And even to take that a step further, I think when we talk about ransomware, that's just the initial event. And there can be a number of different avenues that we get into and a number of different coverage areas that can come into play depending on what happens and what the response is. And so there could be data exfiltration, there could be business interruption, there could be data destruction, there could be restoration requirements. There's so many different results that can come out of this one event. And so to group them all together, I think is really difficult from an underwriting perspective. And then to say that there's one question or 5 questions that we can actually ask as underwriters that are going to dictate whether or not we can control our losses in this particular area, because there's just too many different directions that we can go. I think the trend that we are seeing and what's far more effective is to make sure that we are using all of our knowledge and the aggregation of that to assist the insureds in understanding how to respond and minimize that, because I think the idea that we can prevent ransomware from happening from the onset and that it's not going to result in one of these very, varying endpoints is a bit naive.
So as a way to manage this risk, would you say that there are specific instances of potential loss scenarios that you aren't willing to cover or are no longer willing to cover? Dangerous question.
I mean, I'm not going to say we're not covering anything. No. But I think it's far more complicated than to say, we've got this number of ransomware claims and this is what the result looks like and this is how we can extrapolate a certain expected loss ratio, because I think they actually fall into much broader categories and varying categories. And so I think there has to be a lot more analysis done when you're actually looking at claims trends to break it down further than just saying this was a ransomware event.
Totally. I think that's really, really insightful. I think, the intent versus the effect is absolutely key here. And then how do we overlay the filter on that intent and effect with, the question set at the beginning and then our own ability to react once we've seen it. And I think, whether a lot of this, we know, still does come down to sort of some of the simple hierarchical hygiene factors. But a lot of it's also about what do you do about the temporal axis? What are you doing in terms of, what are your backups? What's your incident response like? How quickly can you put that into effect? And then we've got also to be in a situation where inaction should mean that has consequences. And I think that's been the challenge for a while. I think particularly in the supply-demand curve, maybe we haven't given enough consequences to some of the inaction we've been seeing in the market and from some of the insured.
Thank you, Dan. I think what I'm hearing is that ransomware is still very much insurable and coverage is extremely broad around threats and consequences, despite what you guys are all seeing from a claims perspective. So I'm gonna take that and run with it.
Yeah, I think that the point, just before we run with that, I think the challenge, what we're actually saying is, if you actually look at the way that these ransoms, it isn't the payment that is most of the claim. It's the incident response costs. It's the ensuing BI. It's the potential for old school privacy issues. When we look at the data exfiltration. So all of these factors need to be taken into account. But again, at the beginning of it was a ransom, but we aren't seeing. This is a very much more three-dimensional model than maybe the model we saw even 5 years ago.
Yeah, that's helpful, Dan. I mean, I think if you're not living this day in and day out, it's hard to see reaching some of these losses and these damages can be for any given company. So that's really helpful to frame it in that perspective. I appreciate you all commenting on the ransomware piece because it is definitely a hot topic. But in the interest of time, let's move on to the next slide, which is commenting back on coverage, which I know was part of kind of the introduction. We're talking about the overall health of the market and how the rates are potentially increasing, although I hope to beg to differ. But for me, having been a cyber and E&O broker for my entire career, from a coverage perspective, pushing those boundaries for my clients has always been top of mind, especially in previous years. And what we previously discussed, where there seems to be a trend of thinking that potentially cyber policies don't pay claims or cover claims where insureds have the biggest concerns of what their potential exposure or risk could be. So Dan, taking this into consideration, where are brokers and clients pushing markets from a coverage perspective?
Well, I think you've just hit the nail on the head there, to be fair, Florence. I think that, look, cyber coverage has become, pretty broad over the last few years as, excellent brokers like yourselves have, used the supply-demand curve and the ascendancy you have within that process to gradually widen on a daily basis, and we've ended up with significantly wider wordings over time. I think it's fair to say that that's stopping now. But where is it? Where are we still sort of seeing the greatest amount of pressure? It's on those areas where the client and the broker potentially sees the greatest fundamental risk, and these are on frankly, the systemic factors. Infrastructure issues, outsourced service providers. How many tiers down can we go for that? Those types of issues. And I think, frankly, the problem is the market can't price for when it's pricing directly to the insured. And it's going to have a real problem to price for those. And certainly if we want the market to be sustainable, we absolutely need to be very clear that a lot of those systemic exposures, be that the infrastructure exclusion, be that the war exclusion, and such like those broader systemic issues, those exclusions need to hold in order to make sure the market can price what it's currently seeing on the attritional, if not anything else.
So on that note, systemic exposures, how are you approaching this now from an underwriting perspective than perhaps you were several years ago? Is this more of an a la carte option where you're charging for individual coverage modules or enhancements of policy language? Are you charging individually for these? How are you looking at this? How are you deciding what to charge, quote unquote, extra for or not? Or are you looking at this more holistically?
There's a bit of both. I think that every coverage module should have a charge that comes with it. It's either whether it's allocated within the pricing model or it's an additional price as that module changes. I think historically, maybe, the markets have chosen to sort of erode margin when they've added coverage in. I can't see that being sustainable going forward. And at the same time, whilst I think there's a real value to the a la carte model in terms of taking each individual insured's problems and looking at them particularly, and I'm sure we'll talk about some of the areas particularly when we're looking at the affirmation process and adding back in certain types of cyber coverage where maybe certain other markets are starting to exclude it. I think there's a really clear area there that's a new coverage that can be priced for specifically. When we're looking at the wider sort of cyber coverage, maybe there's a challenge that we need to sort of draw the line and make sure we're pricing our current product well enough.
I think that's a great point, and I do see a trend towards more visibility in terms of how coverage is actually valued and what that premium looks like for the client. I think for years there was this sort of fear about providing too much information to your clients about how you were charging certain elements of the risk. And, this idea that you could piecemeal the coverage to minimize your premium when actually that might not result in being able to contain a loss within one particular insuring agreement. But I do think the trend towards providing a bit more pricing visibility and allowing insureds to make a decision about what's valuable to purchase and what isn't is helpful for them. It's, a risk analysis decision, what's worth retaining and what's worth paying the premium and having that additional protection.
Yeah, if I could jump in with some observations from a market standpoint, not from any particular individual carrier standpoint, but looking at the market, I think the dynamic is that if somebody's willing to throw in dependent business interruption at no charge, they tend to win the account. And for a long time, carriers were doing that in order to win the account. And the problem is, and I'm just seeing some people start trying to take a stand against this and really look at the premium that you're getting, and if you are getting an additional premium, because I don't think carriers have managed, generally speaking, I don't think carriers have managed the dependent business interruption exposure well. They're generally speaking not getting a lot of additional premium for it. And I think it's the type of loss that could come back to really be a problem with a sudden shock event that they haven't priced for. And, I think people have left their pants down a little bit on this one. And I think carriers really should be looking at how they're pricing it and how they're underwriting it and how they're protecting their books of business from the shock event.
I totally agree, Nick. And sorry, Florence. I think that, again, this is a factor of supply and demand. There were markets that were, coming in and trying to be sort of filibusters and getting more market share, and we're happy to provide this coverage without having really any sort of visibility into what they were actually covering. And I think carriers are entitled to understand the exposure that they're assuming. A lot of these requests that have come in over recent years, and I was on the other side of it asking for these same type of enhancements, are things that are really outside of the purview of the actual insured or the carrier, and are very hard to then actually analyze and correlate back to any particular premium. So I think this is a concerning trend. It's a factor of supply and demand, and I also think that you can see how those losses have impacted some of those carriers in terms of how they're either reducing that coverage, pulling it back, putting additional conditions on it, or just exiting the market entirely.
Thanks, Shannon. So, and all of you, what I'm hearing is, in particular, dependent business interruption coverage for that is being scrutinized and potentially being constricted slightly and catching up, if you will, from
more than slightly.
The systemic risk. Remember, I'm a broker. This is my job. Well, let's stay on the coverage discussion just for a couple more minutes. When thinking about emerging areas of risk, things that I hear are issues around biometric coverage from a privacy perspective, data collection versus the loss or theft of data, business practice issues relating to security and privacy. I'm kind of throwing a lot out at you, but are there any of those things or other areas that you might be concerned about that I didn't mention that we should talk about in terms of really being emerging areas of exposures and what you are concerned about looking forward into 2021?
Hey, Florence.
I think this is a great one. Sorry, Nick, carry on. Yeah, carry on, Nick. Sorry.
I'm sorry. Florence, what comes to my mind is the wrongful collection, wrongful use of data. I really think this is going to be an emerging area. We've seen the GDPR in the European Union. We've seen the CCPA in California. We've seen the biometric law in Illinois. I think we're going to see more laws of this type being passed. I saw an article the other day that really left me to believe that consumers are increasingly concerned with how their information is being collected and used. And I think as consumers learn more about what people are actually doing today, they're going to become more and more concerned. And as those concerns increase, I think you're going to see more laws and more enforcement actions, and finally more lawsuits. So I think this is an area that people should be considering from a coverage standpoint. They should be looking for, asking themselves if they can get a policy that covers it, if they want a policy that covers it, and the underwriters should be looking, if this is something they want to cover, and if so, what controls they feel should be in place.
I agree with all of that. I think very much so. I think that this is like all of those things, Nick, and particularly some of this sort of wrongful collection issues, and particularly some that wouldn't be standard towards normal business practice for a certain industry. I think there's got to be some questions been really asked very seriously as to whether the intent was to cover such things versus whether those are actual coverages that the insured themselves want to have. And it comes back to what you were saying, Florence, earlier. But if there are certain things that can be paid for, maybe, but some of these areas are probably going to need to be looked much more closely at, and I suspect we'll see carriers come up with very, very different appetites for certain areas.
Yeah, I take that point. When I think about the fact that we even call this cyber coverage and how widespread, the coverage has become, that word is a little bit of a misnomer in my opinion, but it's what we settled on. And so I think it's natural to want to try to increase the coverage from a lot of different perspectives, because there is the privacy piece of it, there is the business interruption piece of it, there is all of the, event management expenses, and it really runs the gamut. So appreciate you sharing your thoughts on that. And we're going to move forward just in the interest of time on this at the Net Diligence conference that we're doing right now. So I don't want to get into too much into the weeds, but a general question is around how it is or isn't affecting your cyber underwriting books. And Dan, if you want to take that one first, that would be helpful.
Yes. Yeah, so I mean, again, silent cyber, affirmative cyber, non-affirmative cyber, hidden cyber, whichever one we want to call it. I think there's certainly been a large number of actions in certain markets, particularly first-party markets originally, particularly driven by some of the regulators sort of asking carriers in markets that weren't affirmatively covering cyber how much cyber they realized was in their books already, and looking at to make sure that was excluded, which has obviously meant that there's some coverage gaps that clients had that they now want covered, and we're looking particularly at, say, maybe physical damage following. We, we're particularly looking at the marine industry. I think obviously I'm a global head, so my role is, isn't just local to where I sit in London, but certainly London's a classic market where, the marine market is in the ascendancy in London. And so it's a logical place to look for some of the silent cyber rewrites in that side. So it is a growing area we look at within the book, but I don't think it's quite had its day yet. That doesn't mean it's going to not keep growing.
Thank you, Dan and I. We're gonna. Oh, Nick, go ahead. One final comment there.
I think this whole area is a nightmare for insurance brokers. And to set the stage, we've been talking about COVID and the pandemic. And if you think about all the disputes and all the unhappy policyholders that their business interruption insurance didn't apply to a pandemic, and that's a separate discussion, but just to use that as setting the stage. Now think about traditional property carriers, marine carriers are adding exclusion endorsements for cyber to their policies, or they're adding clarification endorsements. And I think I've seen one from a property standpoint that says that they'll cover fire and explosion resulting from a cyber event, but not other types of loss. And when you start to add these endorsements to traditional policies, I think it becomes really unclear what's covered and what's not covered, and the potential for a policyholder to have a claim not covered, not fully covered, and to be really unhappy is really real in my mind, and a real nightmare for an insurance broker that has to try to explain all this to their customer.
I appreciate that, Nick, and I second that. And I would say, at Marsh, the way that we're trying to approach this is to make sure that we're doing it from an interdisciplinary perspective and getting the different business units together, because you can't look at this in a vacuum, right? So I'm not a property broker, but I need to learn a lot about property. When we need to talk to our property and marine folks and other areas of our business to make sure that we are addressing it from, the 30,000-foot view. So I appreciate your comments on that, and we're going to move forward onto underwriting approach. And I know right at the beginning, both Shannon and Nick, you kind of touched upon this, but Shannon in particular, as you mentioned, you've had the experience of working on both the underwriting side and the broking side of the business, which I know gives you a unique perspective when you approach underwriting any specific risk. My question to you is, do you take a holistic approach to cyber underwriting? And if you do, what does that mean?
Yeah, I think you absolutely have to. And maybe it's just, to your point, having that appreciation of understanding what clients are looking for. And ultimately, in both roles, the goal is to get the client the best protection and back up and running as quickly as possible. I don't think anybody is in the business of trying to do policyholders into thinking they've got some really valuable coverage and then wanting to deny it. And to the point earlier, we're in a situation where we're not going to restrict coverage. We're not going to leave the market. We're not going to charge more than we think is fair. And so there are other levers that need to be pulled when you recognize that these risks are not going anywhere. They're getting broader. They're getting more severe. And so we've got to put our insureds in a situation where if they don't have those resources themselves, especially in the current economic environment, we can leverage our experience and our network of providers and provide that assistance to them on the onset just to put them in a better position. So part of that, is in the way that we're providing a product that is holistic in nature. It's not just reactive. It's very different than a lot of other insurance products or some. But we're also applying that to the way that we underwrite it. You have to. It has to match the way that you're providing your product and your policy. And so part of that is just understanding the actual business practices. I mean, I was sort of snickering earlier when we were talking about cyber and how misleading that is as a name. So many of the things that we're covering right now is actually the business practices and the decisions of the insured and the way that they decide to run their business. And so that is reflected in how you take a holistic approach from an underwriting perspective, and then again, understanding how you're going to respond to those incidents once they happen.
Yeah, quick time machine comment. If you went back in a time machine to the first net diligence conference, one of the big points of discussion was, should we call it cyber? Should we call it something else? Because when you call it cyber, when you call it cyber, people tend to think it covers whatever they think cyber means, and that's a little different for everybody as opposed to auto coverage, where the name kind of gives you a much better idea of what it covers, what it doesn't cover. But with that said, I thought that the comments there were spot on in terms of a holistic approach. What we're talking about here is really a risk financing product, taking some money from everybody, paying the losses of the few that have losses. To make that model work, we need to be really effective, really efficient in how we respond to losses. Being effective and efficient, is kind of the recipe that enables us to make a compelling product for people. But to tag on to that in terms of holistic underwriting, I think another issue to look at is the difficulty of collecting underwriting information. We live in a world that seems to be moving faster and faster, and it's harder and harder to get companies to give you underwriting information in terms of a traditional policy application or traditional documents. And I really think we need to look at other ways to get information using, information technology tools, which don't require the customer to, fill out a long application or supply us with a stack of documents.
We could probably spend an entire session on that, so I appreciate that commentary, because I know, it's shifting quite quickly. But in the interest of time, and because this session, really the title is The Impact of COVID-19 as an Update, I think I'd be remiss if I didn't raise the topic of COVID-19 and potential insurance incidents. So we know that there's been a lot of headline news, as you guys have mentioned, as it relates to other lines of insurance, like business interruption losses from businesses that have been critically impacted by the lockdowns and quarantine, thinking about restaurants, bars, hotels, airlines, for example. But Nick, I'm going to toss it back to you. Has COVID-19 actually affected the cyber market, more so due to businesses having to move remote basically overnight? What's the impact there, or is there an impact?
I think COVID has had a impact, but I also think people are trying to create the impact. The natural tendency is to want to talk about COVID-19 and how it's impacting the market, but I don't see it having a lot of direct impacts. With that said, I think there are a lot of subtle, quiet impacts on the market. And just to pick on a couple of things that you just mentioned, a lot of customers are having real issues with their business right now. Retailers, restaurants, bars, movie theaters. Those customers are under a lot of financial strain, and that's going to come into their insurance purchase decision.
I know.
At the same time, that's okay. You know that. Well, at the same time, it's also going to impact the amount of money and where they spend money in terms of IT security controls. There's also a subtle impact on people working from home that, changes slightly the loss exposures. It creates some slightly different exposures in terms of, making sure that people, one example here is we've seen a lot of emails, phishing emails, go out with COVID questionnaire or, some sort of COVID twist to it. So I don't really view that as a direct, COVID is causing losses. I do view that as a subtle impact on the market, and I think there are a number of those subtle impacts.
I think that's a really great point, Nick, because I think it's really hard to say that there's one specific trend when you're looking at the entire market, but actually then when you start to break it down into segments of the market, you might see, for example, larger insureds who are either, stripping out expenses because they're strapped for resources. When you look at the smaller insureds, you actually see how COVID and the immediate switch to working from home actually becomes, the evidence and the test case for why they should be investing in cyber insurance and why they should invest in that as a new line item on their,
Sorry, but I think that's also relative to their industry, isn't it? It's another one of these subtle shifts. It's really easy, as you rightly say, as Nick points out, to tie it into some big meta-narrative and talk about it as a macro picture. But it's another subtle shift. Professional services firms could do that really easily. Manufacturing firms found it very difficult to work from home. There's another sort of nuance within the market that we're going to have to react to effectively.
Yes, thank you. And moving forward real quickly before we wrap it up, I can't believe how quickly time has gone by. I just noticed, Dan, that you mentioned the macroeconomic factors that are affecting this industry. And I think it's important to recognize that, the cybersecurity market is a multi-million-dollar industry, and cybersecurity spending is at an all-time high and continually growing. So is there a parallel between what's happening in cyber risk overall and then the discussion around subsequent risk transfer options?
You'd hope so. It's a great question. I mean, you really would hope so. If we actually look at the total spending on cybersecurity products, this is a $120 billion to $150 billion industry. And yet the cyber insurance market is circa $10 billion of premium, on current estimates. If you look at the amount we spend on sort of fire prevention as a percentage of the amount we spend on property insurance, there's about a 50-50 spend. So, the potential for the market is massive if you look at on that basis. And I think Nick hit the nail on the head as well earlier, and I know this is one of the themes Shannon's kept returning to, is that we need to make sure risk controls, as in the cybersecurity market, is aligned with the risk financing, as in terms of the insurance and the risk transfer. And on top of that, we need to make sure the actual product we're delivering understands both sides of that market really well as well. So this macroeconomic factor is something we are going to have to keep pushing. It's never been, it's this classic issue. We were talking about the idea that the cyber insurance market doesn't pay claims. Well, we've got a market where, if your antivirus doesn't work, they don't send you a check. If we ask you whether your antivirus is on and it doesn't work, we'll send you a check. I think, why have we become the bad guys in that statement?
That's a fair point. And again, something we could get into a lot more detail about, but I want to be able to take some questions at the end here. So I'm going to wrap it up and just summarize. I'd love for each of you to tell us what you are looking forward to in the state of the market in the upcoming months and extrapolating out even over the next few years past 2021. And I'll toss that to Shannon first.
Yeah, I mean, I think one of the things that I've loved about this market over the last several years is just how quickly it changes. And so it's really hard to just stay in one place. And I think that challenges all of us to be really creative and forward-thinking. And I am really looking forward to seeing where this goes over the next several years, as we've got a lot more talent coming into the market that will challenge all of us to continue to move the product forward.
Great. Thank you, Shannon. Nick, any closing comments?
Yeah, I guess my closing comment is I'm going to be real interested to see how the market dynamics change as we approach the end of the year and the beginning of next year. I have a feeling that a lot of participants in the market are going to look at their results for the year and be, can I say, disappointed. And at that point, they're going to start looking to make some changes. That's my little crystal ball. Maybe I'm right, maybe I'm wrong, but I think it'll be interesting to see exactly what happens.
Thanks, Nick. Dan?
I agree with both those comments. I think that there's never a better time to be an underwriter in a market that's changing as fast as this is. And I think there's never been a better time to be an underwriter than a market that's going to firm across the piece and look to sort of harden in certain areas. And I think, again, Shannon hit the nail on the head. There's never a better market, to my mind, to be in. That is this market that's full of intelligent, creative people. That means there won't only be one solution to all of those problems. And I'm really looking forward to the next few years in this market because I think we're going to end up having a really fascinating time. And we're going to keep providing the best product we can to our clients along that journey.
So we've unfortunately come to the end of this session, but we will now roll over to live questions. We have just a few minutes to take additional questions that we've received from the audience. And particularly in light of the very recent guidance by the U.S. Treasury Department stating that payments of ransom might violate OFAC regulations, I'd like to toss this one over to Nick first. Nick, what do you think are the most important things insureds are doing to mitigate the ransomware threat?
Well, right off the bat, the computer security experts out there tell us that the most frequent source of ransomware infections is open RDP or remote desktop protocol ports. So right off the bat, I would suggest either turning those services off or properly protecting those services, usually via two-factor authentication. It's probably the first thing. The other thing that comes to mind, or the other source of those infections, is quite frequently employees clicking on links or attachments that have malicious attachments. One thing that I think is a particularly good control there is removing administrative privileges from personal computers so employees can't install software. And what that means is when they click on those malicious attachments, the software hopefully won't be able to install. It's not a perfect control, but it's a good start.
Great, thanks, Nick. Shannon, is there anything else that you think might be relevant to help insureds think about when they're thinking about mitigating their ransomware attacks?
Yeah, I mean, I think a number of things that we talked about in this morning's session. I think Nick is certainly spot on with the RDP risk, but what we've seen is that there's a number of different results that can come from this one, particular event, as Dan got into more detail about earlier. So I think in addition to making sure that you've got the actual right physical controls and technological controls in place, it's really just making sure you know exactly how you're going to respond once that event happens and relying on the experts that are going to help guide you through that.
Thanks. And just sticking on the ransomware for one more minute, because I know that in light of that news last week, there have been a lot of questions. From an insurer perspective, knowing that you're not responsible for ransomware, is there anything you can think of where you might be able to take a more active role in managing that severity or frequency with your clients, with your insureds?
Yeah, absolutely. And I think we're seeing a number of carriers do this. And there's a recognition that we're going to have a lot more insight into actual trends and the aggregation of all of these different events, whether it's identifying who the actual actor is or different fact patterns. I mean, there's so much that carriers can do to leverage that information and push it back to their clients proactively so that they're putting them in a better position. So, I think it remains to be seen how policies are actually going to change based on the guidance from Friday. I think we've seen, events like this happen in the past where actual regulations might threaten our ability to actually pay claims. And so it remains to be seen how this is actually going to be enforced. Of course, we would expect everybody to comply with OFAC regulations. But again, there's still a lot of valuable tools and information that can be pushed back to clients outside of just purely paying a claim. I think we can recognize that cyber has taken on a much larger role than just being a reactive, financing vehicle.
Yeah, I agree. That's a great reminder. Go ahead, Nick.
If I could jump in real quick, I think that's spot on, and I think it speaks to the value of the cyber response services that insurers offer. The information that insurers see, to Shannon's point, and being able to share that information, as well as helping to connect the insured with the right vendor for the right breach, I think is really powerful and a really important part of our service.
That's a great reminder for insureds that this isn't just a financial risk transfer option, but there are also a lot of value-add services that they should be aware of. So thanks for that. And then we just have about a minute left. And one thing we didn't get an opportunity to chat about is the reinsurance market and whether or not it affects your ability to write cyber. Shannon, you want to take that one?
Yeah, I'll just jump in quickly. I mean, I think the reinsurance market is critical for our ability to provide cyber insurance in a sustainable way, so long term. They are basically enabling every direct market, not only with the ability to assume the losses that are coming just because of the trends frequency and to remain very competitive, but they're also a really valuable source of information because, again, they've got the opportunity to look into this information and leverage that and provide it back to all of the carriers that they're partnering with.
Great. Thanks, Shannon, and thank you, Nick. We've gotten to the top of the hour, so I really want to thank Shannon, Nick, and Dan for their time today and their unique insight into the cyber marketplace. We certainly appreciate your time and viewpoint of where we've been and where we might be headed. So thanks, everyone.
Thank you.